Welcome back to Future Business School. Today is day 18 of our Daily MBA series, and we'll be diving into the critical skill of financial statement analysis. Whether you're a business owner, investor, or manager, understanding how to analyze financial statements is essential for making informed decisions. Today, we'll explore how to read and interpret key financial documents like the balance sheet, income statement, and cash flow statement to evaluate a company's performance. Let's get started. What is financial statement analysis? Financial statement analysis is the process of reviewing and evaluating a company's financial reports to assess its financial performance, risk, and potential for future growth. By carefully analyzing balance sheets, income statements, and cash flow statements, you can gain insights into the company's strengths, weaknesses, and overall financial health. There are several methods of analyzing financial statements. Horizontal analysis, which involves comparing financial data over multiple periods to spot trends. Vertical analysis, which focuses on the relationship between different line items in a single financial period. And ratio analysis, which uses financial ratios to measure profitability, liquidity, and leverage. Step 1. Horizontal and vertical analysis. Horizontal analysis compares financial statements over different periods, months, quarters, or years to identify growth trends or red flags. It shows the percentage change in specific line items like revenue, expenses, or assets. For example, if a company's revenue grew by 10% from 2022 to 2023, this signals positive growth. However, if expenses grew by 15% in the same period, it could indicate a potential issue with cost control. A real-world example. Apple's horizontal analysis may reveal that its services segment, like iCloud and the App Store, has seen faster revenue growth compared to hardware products, indicating a shift in its business strategy. Vertical analysis involves expressing each item on a financial statement as a percentage of a base figure. For example, on the income statement, you might express each expense item as a percentage of total revenue. This helps identify how different items contribute to the company's performance. In a vertical analysis of the income statement, if marketing expenses represent 15% of revenue in year 1 but jump to 25% in year 2, this would raise questions about whether the increase is justified by the resulting revenue growth. Real-world example. On a balance sheet, you might compare a company's inventory as a percentage of total assets. If a retail company like Walmart shows that inventory has increased to 40% of total assets, it may indicate excess stockpiling or slow sales. Step 2. Ratio analysis. Ratio analysis is one of the most powerful tools for financial statement analysis. Ratios provide quick insights into a company's liquidity, profitability, and solvency. Here are some of the key financial ratios. 1. Liquidity ratios. Assess a company's ability to meet short-term obligations. Current ratio. The current ratio is calculated as current assets divided by current liabilities. A current ratio above 1 indicates that the company has more than enough current assets to cover its short-term liabilities. A current ratio below 1 may signal liquidity problems. Quick ratio, also known as the acid test ratio. The quick ratio is calculated as current assets minus inventory divided by current liabilities. This ratio removes inventory from current assets since inventory can take time to liquidate. It provides a more conservative measure of liquidity. For example, a tech company with a quick ratio of 3.5 is in a strong financial position, meaning it has $3.50 of liquid assets for every $1 of liabilities. Profitability ratios. Measure how efficiently a company generates profit. Gross profit margin. Gross profit margin equals gross profit divided by revenue. This ratio shows the percentage of revenue that exceeds the cost of goods sold. A higher margin means the company retains more profit per dollar of sales. Net profit margin. Net profit margin equals net income divided by revenue. The net profit margin measures overall profitability after accounting for all expenses, taxes, and interest. A high net profit margin indicates efficient cost control. For example, Amazon's net profit margin may be lower than Apple's due to heavy reinvestment in infrastructure and technology, despite Amazon's massive revenue base. Leverage ratios measure how much of the company is financed by debt. Debt to equity ratio. Debt to equity ratio equals total liabilities divided by shareholders' equity. A high debt to equity ratio indicates the company relies heavily on borrowed funds. This could be risky if the company faces cash flow challenges or rising interest rates. Interest coverage ratio. Interest coverage ratio equals EBT divided by interest expense. The interest coverage ratio tells you how easily the company can pay interest on its outstanding debt. A ratio below 1 could signal potential problems with servicing debt. For example, Tesla's debt-to-equity ratio may be higher than that of other automakers due to its investment in production facilities. But its high interest coverage ratio suggests it can comfortably meet interest payments on its debt. Efficiency ratios. Assess how efficiently a company uses its assets. Inventory. Turnover ratio. Inventory turnover equals COGS divided by average inventory. This ratio shows how quickly a company sells its inventory. A low inventory turnover ratio could indicate excess stock, while a high ratio suggests efficient inventory management. Asset turnover ratio. Asset turnover equals revenue divided by average total assets. This measures how efficiently a company uses its assets to generate sales. A higher ratio means the company is generating more revenue per dollar of assets. Step 3. Using cash flow analysis. The cash flow statement shows the company's cash inflows and outflows from operations, investing, and financing activities. Understanding cash flow is crucial for assessing a company's liquidity and long-term viability. Key cash flow metrics. Operating cash flow, or OCF, is the cash generated from a company's core business operations. Positive OCF is essential for a business to sustain itself. Free cash flow, or FCF, is the cash available after the company has met its capital expenditure requirements. It's a good indicator of a company's ability to reinvest, pay dividends, or reduce debt. For example, Netflix, despite showing profits on the income statement, had negative free cash flow for many years due to its heavy spending on original content. Investors should watch free cash flow to assess sustainability. Step 4. Interpreting financial health. When analyzing financial statements, it's important to look beyond just the numbers. Here are some key considerations. Industry benchmarks. Compare the company's performance with industry standards. A current ratio of 1.5 might be considered low in a technology firm, but acceptable in a utility company. Historical performance. Review trends over time. If profitability is consistently declining, it could signal deeper issues that require further investigation. Qualitative factors. Consider non-financial factors like leadership quality, competitive position, and market conditions that might not be reflected in the financials but have significant implications. Real-world example. Analyzing Amazon. Let's apply financial statement analysis to Amazon. Profitability. Amazon's gross profit margin has been increasing, driven by its high-margin cloud computing business, AWS, even though its net profit margin has remained relatively low due to large reinvestments. Liquidity. Amazon's quick ratio is healthy, meaning it has sufficient liquid assets to cover its short-term obligations despite its heavy inventory for e-commerce. Cash flow. Amazon generates strong operating cash flow, which supports its aggressive expansion strategy. Its free cash flow has fluctuated due to investments in warehouses and technology. conclusion, and key takeaways. In conclusion, financial statement analysis is crucial for assessing a company's financial health, performance, and future prospects. By performing horizontal, vertical, and ratio analysis, you can get a deeper understanding of a company's profitability, liquidity, and efficiency. Always remember to consider both quantitative metrics and qualitative factors when making business or investment decisions. Thanks for watching. Be sure to like, share, and subscribe to Future Business School for more business insights. Join us in the next episode where we'll explore budgeting and forecasting.